80% of retail investors lose money in their first year, not because the market is rigged, not because Wall Street cheats them, but because they're playing a game where they don't even understand the rules. I'm Grace, and today we're fixing that. We're going through over 50 stock market terms, but not as a random glossary dump. We're going to organize them the way professional investors actually think about them. 6 categories, each one builds on the last. By the end, you won't just know the words, you'll understand how they connect. Let's start at the very beginning. What is a stock? And what does owning one actually mean? A stock is a unit of ownership in a company. When you buy a share of Apple, you literally own a tiny fraction of Apple, its future profits, its assets, everything. There are 2 types. Common stock is what most of us buy. You get voting rights on big company decisions, and you can benefit from dividends, but they're not guaranteed. Preferred stock works differently. You usually give up your vote, but you get more reliable dividend payments, and if the company ever pays out to shareholders, you're a headline. Most beginner investors start with common stock. That's what you see trading on exchanges every day. A few terms that go hand in hand with stocks. A shareholder is simply anyone who owns shares. Your portfolio is everything you own: stocks, funds, bonds, all of it together. Dividends are when a profitable company decides to share some of that profit directly with shareholders, usually every quarter. And not every company is available to buy. Public companies list their shares on exchanges. Anyone can invest. Private companies keep their ownership closed. Their shares aren't on the open market. Stocks trade on a stock exchange, a marketplace where buyers and sellers meet. The 2 biggest in the US are the New York Stock Exchange and the NASDAQ. You can't walk onto the floor yourself. That's where a brokerage comes in. Platforms like Fidelity, Schwab, or Robinhood connect you to the exchange and execute your trades. Every public company is identified by a ticker symbol, short codes like AAPL for Apple or TSLA for Tesla. Regular market hours run from 9:30 a.m. to 4 p.m. Eastern. But pre-market and after-hours trading exists too, useful for reacting to earnings or news, though they come with lower volume and wider spreads. Market capitalization, or market cap, tells you the total value of a company on the stock market. Take the stock price, multiply it by the number of shares outstanding, and that's the market cap. It's how we size up companies. Large cap companies, worth over $10 billion, are your Apples and Microsofts. Stable, established, lower volatility. Mid-cap sits between 2 and 10 billion, often in a growth phase. Small cap comes in under 2 billion, higher upside potential but more risk. And penny stocks are shares priced below $5. They're heavily speculative. Some moon, most don't. An index is a curated basket of stocks used to track a slice of the market. The S&P 500 follows the 500 largest U.S. companies. It's the benchmark most investors compare themselves to. The Dow Jones tracks just 30 companies. The NASDAQ skews tech. When someone says beating the market, they mean outperforming the S&P 500. And here's the reality. Over a 15-year period, roughly 90% of actively managed funds fail to do it. Now, let's talk about the numbers, because picking a stock without reading its financials is like buying a house without looking inside. Revenue is the total money a company brings in from sales. Subtract all its costs, salaries, rent, materials, taxes, and what's left is net income. That's the actual profit. From net income, we calculate earnings per share, or EPS. Divide the profit by the number of shares outstanding. If a company earns $100 million and has 50 million shares, EPS is $2. Higher EPS generally means a healthier company. You'll also hear about the balance sheet, a snapshot of what a company owns, called assets, versus what it owes, called liabilities. A company drowning in debt relative to its assets is a warning sign. Valuation ratios are how we decide whether a stock is expensive or cheap. The P/E ratio, price to earnings, compares the stock price to its earnings per share. A high P/E could mean investors expect strong future growth, or that the stock is overpriced. Context matters. The PEG ratio takes P/E a step further. It adjusts for expected growth, so a fast-growing company's P/E looks more fair. The P/B ratio compares market price to book value, what the company's assets are worth on paper. And dividend yield tells income investors how much return they're getting purely from dividends relative to the price they paid. 3 margins tell you how efficiently a company converts revenue into actual profit. Gross margin is what's left after the direct cost of making the product. Operating margin strips out salaries, rent, and overhead. Net profit margin is the final number, what's left after every expense, including taxes and interest. A company with high revenue but razor-thin net margins is working incredibly hard for very little. That's why margins matter as much as top-line revenue. Free cash flow is often more telling than reported earnings. It's the cash a company has left after running the business and paying for investments in equipment or infrastructure. Earnings can be manipulated through accounting. Free cash flow is much harder to fake. It either shows up in the bank account or it doesn't. Markets aren't rational machines. They're driven by millions of people making emotional decisions simultaneously. Understanding market moods is how you avoid getting swept up in them. A bull market is a sustained rise in stock prices, typically defined as a 20% gain from recent lows. Optimism runs high. Portfolios look great. The average bull market lasts 3 to 4 years. A bear market is the opposite, a 20% drop from recent highs, with fear dominating sentiment. The average bear market lasts around 9 months and sees stocks fall roughly 36% on average. They feel terrible while they're happening. But every single bear market in history has eventually ended in a new bull market. A few more market mood terms. A correction is a 10 to 20% pullback from recent highs. They're normal. They happen regularly, and most investors overreact to them. A rally is a sharp recovery after a dip. A crash is more severe, sudden, deep, usually panic-driven. And a bubble is when prices climb so far above a company's real value that the only thing holding them up is enthusiasm, until it runs out. When bubbles burst, the landing is ugly. Volatility measures how wildly a stock swings in price. High volatility stocks can move 10% in a day. Low volatility stocks barely move. Traders watch the VIX, often called the fear index, to gauge overall market anxiety. When VIX is above 30, the market is in stress mode. Below 15, things are calm. Volatility isn't inherently bad, it's just risk, and risk can go both ways. The broader economy shapes the stock market constantly. Inflation is when prices rise over time. Your money buys less. A little inflation is healthy. Too much erodes returns. Deflation is the opposite, falling prices, which sounds great until you realize it signals weak demand and a slowing economy. A recession is when the economy contracts for at least 2 consecutive quarters. Recessions typically drag earnings and stock prices lower. Stagflation is the worst scenario, high inflation and low growth at the same time. It's rare but brutal for markets. 2 big forces move markets beyond company performance. Monetary policy is the Federal Reserve controlling interest rates and money supply. When the Fed prints money, quantitative easing, more dollars flow into markets, pushing prices up. When they pull money back, quantitative tightening, the reverse happens. Fiscal policy is what the government does with taxes and spending. Stimulus boosts growth. Austerity slows it. Don't fight the Fed. It's a real rule. You know what to look for in a stock. Now let's talk about how you actually buy and sell one, because the mechanics matter more than most beginners realize. When you place a trade, you're not just hitting buy. You're choosing an order type, and each one works differently. A market order executes immediately at whatever the current price is. Fast, but you have no control over the exact price you get. A limit order only fills at your specified price or better. You control the price, but there's no guarantee it executes. A stop-loss order automatically sells your position if the price drops to a level you set. It's a safety net. A good-till-canceled order stays open until it fills, or you manually cancel it. A day order expires automatically at market close if it hasn't filled.
Every stock has a bid price, the highest a buyer is willing to pay, and an ask price, the lowest a seller will accept. The difference between them is called the spread. On highly liquid stocks like Apple, the spread might be a penny. On small or thinly traded stocks, it can be much wider, and that gap costs you money every time you trade. Volume tells you how many shares are changing hands each day. High volume means high liquidity. You can get in and out without your order moving the price against you.
Going long is the classic move. Buy a stock, hope it rises, sell for a profit. Your loss is capped at what you invested. Shorting flips the strategy. You borrow shares, sell them immediately, and wait for the price to fall, then buy them back cheaper and pocket the difference. The risk? A stock can fall to zero, but it can theoretically rise forever. If you're short and the stock runs up instead of down, your losses are unlimited. That asymmetric risk is why shorting is an advanced strategy, and why most beginners should stay away from it. A short squeeze happens when a heavily shorted stock suddenly rises, forcing short sellers to buy back shares quickly to cut their losses. That forced buying drags the price even higher, which forces more short sellers to cover, which pushes it higher still. It's a cascade. The GameStop situation in 2021 is the most famous recent example. Retail investors on Reddit deliberately targeted a heavily shorted stock, and the short squeeze that followed cost hedge funds billions.
A few terms you'll hear constantly. To the moon means a stock is rising fast. Tanking is the opposite. A dead cat bounce is a brief recovery in a falling stock. It looks like a turnaround, but isn't. Whales are investors with so much capital their trades physically move the market. And pump and dump is fraud. Someone hypes a stock, price rises, they sell at the top, everyone else holds the loss. You'll see it most in penny stocks and low-cap crypto.
Not everyone invests in individual stocks, and honestly, most people probably shouldn't start there. Let's cover the main investment vehicles available to retail investors. A mutual fund pools money from many investors, and a professional manager picks the investments. You get diversification, but you pay for the management through fees, and most actively managed funds underperform the index over time. ETFs, exchange-traded funds, are similar to mutual funds, but they trade on an exchange just like regular stocks, can be bought or sold anytime during market hours, and typically carry lower fees. An index fund is a specific type of ETF or mutual fund that simply tracks a market index, like the S&P 500. No active management, no stock picking, just match the market. It's the strategy that beats most professionals over the long run. A bond is essentially a loan you give to a company or government. In return, they pay you regular interest, called a coupon, and return your original investment when the bond matures. Bonds are generally lower risk than stocks, which is why they're popular in conservative or retirement portfolios. One key mechanic: bond prices and interest rates move in opposite directions. When interest rates rise, existing bonds paying lower rates become less attractive, so their market price falls. This matters if you ever buy or sell bonds before they mature. Beyond stocks and bonds, commodities are physical goods like gold, oil, and agricultural products. Gold in particular is often used as a hedge against inflation and market instability. Forex is the foreign exchange market, trading currency pairs around the world. It's the largest financial market on Earth by volume. And cryptocurrencies are digital assets operating outside the traditional financial system. High volatility, 24-hour train, and still evolving regulation. Tax-advantaged accounts are one of the most powerful tools available to everyday investors, and a lot of people underuse them. A Roth IRA lets you invest after-tax dollars, but your gains grow completely tax-free, and withdrawals in retirement are tax-free. The annual contribution limit is $7,000.
A traditional IRA or 401k flips it. You invest pre-tax dollars, reducing your taxable income now, but you pay taxes when you withdraw in retirement. Which one you prioritize depends on where you expect to be tax-wise in the future. The last section is arguably the most important, because having all the vocabulary in the world doesn't matter if you don't have a strategy for putting it to work. Diversification is the closest thing to a free lunch in investing. Spreading your money across different companies, sectors, and asset types means a collapse in one area doesn't collapse everything. Asset allocation takes that further. It's the deliberate division of your portfolio between stocks, bonds, real estate, and other asset types based on your goals and risk tolerance. Over time, as markets move, your allocation drifts. Rebalancing is the process of selling what's grown too large and buying what's fallen behind, returning to your original target. It enforces discipline and keeps your risk level where you want it. Passive investing means buying a broad index and holding it. No stock picking, no market timing. You contribute regularly through dollar-cost averaging, the same amount every month, regardless of whether prices are up or down. It smooths out volatility and keeps emotions out of the equation. Active investing means picking individual stocks or trying to time your entries and exits. Value investors hunt for undervalued companies. Growth investors target high-growth names. Day traders buy and sell within single sessions. Swing traders hold positions for days to months. Active investing can outperform, but it's harder than it looks, and most people underestimate the cost of being wrong. Two types of risk sit at the heart of every portfolio. Systematic risk affects the entire market: recessions, rate hikes, geopolitical shocks. You can't diversify it away. Unsystematic risk is specific to a company or sector: a CEO scandal, a failed product launch, regulatory action. This kind you can reduce through diversification. Performance metrics help you evaluate how well you're managing risk. Alpha measures how much you outperform the market. Beta measures how sensitive your portfolio is to market moves. The Sharpe ratio tells you how much return you're getting per unit of risk. Higher is better. Two frameworks dominate how investors analyze stocks. Fundamental analysis digs into the actual company, its financials, management team, competitive moat, and industry position. The goal is to figure out what a company is truly worth and whether the market has mispriced it. Technical analysis ignores the company entirely and studies the price chart, looking for patterns, trends, support and resistance levels, and volume signals that might predict future moves. Support is a price floor, a level the stock keeps bouncing off. Resistance is the ceiling. Most experienced investors use elements of both. Two concepts that work in opposite directions. Compound interest is the most powerful force in long-term investing. Put $10,000 in at 10% annually and leave it alone for 30 years. You end up with over $170,000 without adding a cent. Time is the variable that matters. Leverage is borrowed money used to amplify positions. It can supercharge gains, but it works equally hard on losses. A 2x leveraged position loses twice as fast when markets fall. Leverage is how fortunes are built and destroyed. A few important corporate actions to know. An IPO, initial public offering, is when a private company lists its shares publicly for the first time. A stock split increases the number of shares by dividing each existing share. The price drops proportionally, but your total value stays the same. A buyback is when a company purchases its own shares, reducing supply and often boosting the value of remaining shares. And if you own dividend-paying stocks, the ex-dividend date is the cutoff. You need to own the stock before this date to receive the upcoming payout. 3 things to take away. 1. The language matters. Every expensive mistake starts with someone not understanding what they were actually buying. 2. Diversification and time in the market beat clever stock picking for most investors. The compounding math is overwhelming. 3. Risk isn't the enemy. Unmanaged, misunderstood risk is. Know your exposure, have a plan, and don't let fear or greed make your decisions for you. If this helped you decode even a handful of terms you'd been glossing over, drop the one that finally clicked for you in the comments. Like this video if it was worth your time, and subscribe if you want more finance explained without the noise.